I want to talk about losing because losing is probably more important to day trading than winning is. Because if you don't know how to lose, it never really matters how much money you make. Now, how many times have you woken up in the morning? Analysts are saying, hey, it's a bull market, Meta, Microsoft leading the way with AI innovation. You are pretty sure you're going to make a king's ransom and you go long. Then the market goes short, like it did today. We're going to go ahead and look at this. This is Topstep really quick. Guys, I'm up 75 bucks on this trade. I was down as much as 2,000, ultimately leading to this lesson. But if we look here, my P&L is over $4,000 for this eval. Looks like I'm on the verge of meeting my one-day max. And I'm going to show you how I did that because this was my very first trade that I found myself losing. This is the 1348 chart. And let's talk about this thesis here where we were bullish because of Microsoft AI surprising the market yesterday, but then immediately bearish. What I'm going to do is I'm going to delete the drawings here. And in deleting these drawings, I sort of kind of want to make a scenario very real and something that you've experienced and I've experienced very early on in my career. And that is the unwillingness to accept that you're wrong. You see, you had plans on going long. The market had different plans. You see the candle close and possibly the wick signaling reversal. Nope. Then we have a candle here signaling a reversal. Nope. Then we have a candle here signaling a reversal, very short-lived. And then here comes the pain and the duress all the way down here. Okay. Now let me ask you something. In trading, what matters more, the trend or your ego? And I say this because this exact example is what creates a capstone featurette in trader psychology. You see, should price action return? Well, a lot of traders that succumb to the pain of losing and being wrong and averaging down will say, damn it, if I just held longer, I could have broken even. Damn it, if I just would have held longer, I could have made money. And so now this becomes more of a competition against your ego than recognition that you're wrong with accountability and recognition of the trend. So you're always going to be blind to the sentiment of the market because you're always fighting your ego. So what are some of the ways to mitigate these type of losses? Now, one way is to have a trade plan. And with a trade plan, you would set how much you're willing to lose. So I'm willing to risk 3,000 per trade. And in doing so, my system tells me I can trade 10 contracts if I'm risking 3,000 per trade. But I'm not going to do 10 contracts. I'm going to do 2 contracts. It's equivalent to just testing the waters, right? Getting a feel for it, seeing if the water's room temp or just boiling and gonna cook your foot like some mean lobster. We scale into a trade. Remember, scaling and dollar cost averaging, very, very, very different. Scaling is when we scale into winners. We do not dollar cost average into losers. Now, if my thesis was truly bearish instead of bullish, I would start off with 2, and then I would add scale into my trade upon the break of levels. And we have multiple levels of which we break on the way down. Now, remember we talked about how traders get so excited about the money they can make and not the money they lose. Some will say, well, I would make more money if I just entered with 10 contracts initially. Absolutely. But what you want to do is train yourself to mitigate loss. You see? So that is one way of doing it is scaling into your winners and your winners alone and not dollar cost averaging into your losers. This changes the game. It no longer becomes I'm a trader. It becomes I'm fighting my demons. Now, another way to do this, let's say we're long here, instead of a full 10 contract allocation that it's saying here on the chart, 10 contracts, what I'm going to do is enter with two. And then should I be wrong, regardless of the direction, should I be wrong and the market's telling me I'm wrong? What I then do is I enter a slightly larger allocation in a different instrument. So let's say you started with 5 MESs and you were proved wrong. You could afford yourself up to 50 MESs. But instead of dollar cost averaging up to 50 MESs, what you do is you simply go on over to ES and you go long. So now you're hedging. But what you've done is you've dynamically created a 2-to-1 risk to reward environment, 5 MESs versus 1 ES. Those who understand futures and futures contracts would know like a 5 MESs is like half an ES. And if you apply this to like stocks, it's like saying, hey, I bought 5 shares of Apple and I took it long. I'm going to buy 10 shares of Microsoft and take it short. Okay. And this is why options exist. Options are a hedging instrument. And this is how day traders hedge their trade with options contracts. Back to this here. If you look at my Topstep eval, I am actually up too much. I was eventually right, but I had to afford myself time. This is only 3 contracts. I had to afford myself time, and I did so with ES. Now, what I want to do is I want to show you guys what my performance looks like. I have not taken a loss yet. Well, I took a very, very, very small loss for $53, and this is because I was averaging into my winners. But you could see my profit factor is 82.71. My win percentage, 93%, and my average win loss is 5.51. You cannot internalize a loss, then afford yourself more time, or acknowledge that you're wrong for the moment and buy yourself time by actually trading with the market so that the trade itself has time to be right. And that's what we do with hedging. Otherwise, you trade small, very, very, very small, and allow yourself to be right. Ultimately, what you can do is simply cut your trade and just go with the trend of the market. Now, how do we know the trend of the market? Well, my traders here at 1348 understand that once we have a red GT or bearish, they also understand that they cannot enter trades against a trend. So although we have a signal here and we have sentiment to the bull side, they will not enter that trade. They will, in fact, look for better positioning to take it down south. They will not re-enter here. They will, in fact, look for better positioning to take it down south. They will only become bulls should they break GT to the upside here. Once you allow yourself to be wrong, or once you scale down your trades so that you have a longer time horizon to be wrong, that's when your trading career just goes to the moon. It is by no coincidence that investors who have long-term horizons, 10-year horizons, no coincidence that a lot of them become very wealthy because they have such a long-term horizon. They know that their trade is eventually going to be right, and of course, help build wealth, especially with indices such as NQ and ES, because, well, those markets, all they do is go up. Independently of Pepsi and Microsoft and Tesla, just truly just goes up. So We trade small to give ourselves a longer time horizon. We trade small to allow ourselves to diversify into other trades and go with the trend because the trend is our friend. Or we completely cut the trade and then join our friends with the trend. These actions will help you develop a healthy relationship with the market and prevent a toxic relationship with your ego. Because once that relationship becomes toxic, you're no longer a trader, you're a gambler. I'm signing out. Thank you for joining me. Peace.